Good afternoon, ladies and gentlemen. Today we hold a special conference. First of all, because I have an excellent chance to refresh my English, but the main reason is that we keep our eyes on the capital of Great Britain and its real estate market in particular. A year ago, when pandemic has just started and we all had no idea what it would turn into, we talked with Consulco Group co-founder and director Dmitry Hankin about perspectives of London realty, keeping in mind not only COVID, but Brexit as well. Dmitry said then that real estate and especially premium property were, how did call it, a secure harbor. Yes, Dmitry? Is that correct?
Спасибо, Рамаз. Был очень интересный разговор у нас почти год.
Thank you, Ramaz. We had such a wonderful conversation back then, a year ago.
And in February 2020, United Kingdom was only on its way to part with the European Union, and people all over the world didn't really care about pandemic. In March 2021, the United Kingdom is free from Brussels, but at the same time, we see what COVID turned the planet into. But can you repeat your words about London real estate market today? These and other questions we are going to discuss today, not only with Dmitry Hankin, but with our honorable experts. Before I introduce them to the audience, I kindly invite all our viewers to get involved in our conversation and ask you questions. To do that, you should enter our kommersant.ru site, then choose event section, fulfill a simple registration form, and welcome with your questions. And now, dear speakers, let me introduce you to the audience. Richard Holt, Head of Global Cities Research, Oxford Economics. Richard, very nice to welcome you.
Thank you. Good to be here.
Dmitry Hankin, co-founder and director of Consulco Group. Dmitry, once again, good evening. Good day. Sorry.
Здравствуйте. Большое спасибо всем за участие.
Hello, and thank you everyone for taking time and joining our conference today.
Мой шанс сказать пару слов.
If this is my chance to say a couple of words about our today's event, then thank you. Consulco Group will celebrate its 28th anniversary this year. For the last 10 years, we've been seeing some very nice historic track record. Consulco is a high-performance investment manager structuring and managing London real estate. We work in such areas as Soho, Covent Garden, and many others. And we are proud to say that when it comes to our net annual yield, our portfolio yield is around 11%. Our financial company, London Credit, that is based in London, is a company that provides short-term loans to the business community of the UK. They're all secured against London real estate. London Credit Fund has seen some very impressive results when it comes to payback. And the net return exceeds 4% per annum. Speaking about London, London is a major financial center across the globe, and it is a big and robust real estate market. From the point of view of liquidity as well, that is why it is not a surprise to me that Russia's investor community follows closely the developments in the London real estate market. Our partners regularly speak to us about various real estate deals in London and across the UK. These deals vary in size, scope, and the number of parties involved. Today, we welcome our partners from Oxford Economics, CoStar, MSCI. Our speakers today will be sharing their insights into what will happen to the real estate market in the UK and namely in London. They will also share with us their thoughts on potential challenges and opportunities that are opening to us in London. Of course, against a very difficult backdrop, it is okay for investors to think about the risks and to think about the ways to mitigate them. But it's very important to follow the situation closely, to take advantage of the opportunities that present themselves against such a difficult backdrop. For example, after the global financial crisis of 2001, our company in 2010 to 2015 invested in real estate. And we are proud to say that our investors got 30% throughout 5 years. That is a very nice return on investment. And that is a very illustrative example of how one can take advantage of opportunities that present themselves. Today, we have a very cheap fund. The interest rates are around zero, which means that capital value is pretty affordable. And we also see many new opportunities in the UK and namely in London. So maybe now it is high time for us to discuss opportunities and forecasts of what will happen in the UK, because potentially the economy will be on the rebound pretty soon. I do hope that our today's discussion will be meaningful and insightful, as well as interesting. Thank you so much.
Thank you very much, Dmitry, for this welcoming speech. And now, if you allow me, I will continue to present our speakers. It was Dmitry Henkin now, and then we will talk to Helen Demi, MSCI Executive Director. Helen, hi.
Hello. Good afternoon, everyone. Thank you for having me.
Mark Stansfield, Head of UK Analytics, CoStar Group. Mark, welcome.
Thank you very much, and good afternoon, everyone.
And already mentioned by Dmitry, David King, Head of UK Real Estate of Consulco Group. David, nice to see you.
Thank you, and good afternoon to you all.
Richard, if you don't mind, I will ask you the first question, because I'm really interested in what place right now, after a year of pandemics and after almost three months of UK being absolutely independent from the European Union, how does the real estate market feel right now? London real estate market.
Thank you for that question. Hopefully you can see my screen. So I've got some slides so I can give you some thoughts on this. I'm not a real estate advisor. I'm not a real estate investor, except that I own my own house, like most of us do. I'm going to talk a bit about the economic fundamentals, but I'll draw out some implications of what some of that might mean for real estate. But colleagues here have much more expertise in the sector than I have.
Please, you're welcome.
I'm just trying to move my screen on. There we go. So the big issues facing...
yes, we see you.
Yeah, great. So the big issues facing London, first of all, obviously, is the speed of the recovery from the pandemic, but also the impact of new technology which has been in the background as an issue for several years. But one of the things which the pandemic has done is really concentrate our minds on questions which we probably should have been asking before, but on the whole were not, about the future of online shopping rather than bricks and mortar shopping, on the opportunities for working from home in the way in which so many of us are doing now, and a subject which has been quite live in London at the moment, and therefore I want to say a little bit about, which is migration away from big cities, people becoming concerned about the risks of living in big cities and seeing the opportunity that the new technology gives us to live in other places. I'm not going to dwell very much on these factors, but clearly they're very important. And also the issue of Brexit, which has already been highlighted. I'll say a little bit about that. But if I just start with the 2020, 2020 was a difficult year for the whole world, but more difficult for London than for some cities. We think that GDP, or GVA as it's described here, it's the same thing, in the London economy probably fell by almost 10% in 2020. That's kind of the worst figure for about 300 years. It's an extraordinary figure. It reflects the fact, one of the reasons behind that is the fact that London is the most global city in the world. And on a global pandemic, it shouldn't be surprising if a very global city suffers in particular. And you don't need me to go through all of the other factors involved in terms of the things that have been happening to cities around the world, London included. Something which I do want to draw attention to, however, is the fact that employment in London fell only slightly in 2020, largely because of government schemes designed to protect employment and prevent it from falling further. And this story about the difference between output and employment is important going forward. But where we are at the moment, I think, is that the London economy, like most economies, is actually on the way up, particularly because of good news in terms of the vaccines. The vaccine rollout is going very well in the UK. Significant proportion of the population has received the vaccine. And so long as that continues, and so long as the virus itself continues to be pushed back and back, it's sensible to be reasonably optimistic about the prospects for 2021. So this is what we call our normality tracker, which is just trying to say how near back to normal is the London economy. So it's picking up 2 or 3 different measures, such as coronavirus cases themselves, whether people are actually in their workplaces, whether people are out in shops, a couple of other indicators. And what it's telling you here is that over the last couple of months, London has been moving back towards normality. However, it is behind the average for other European cities. It's not as far from it as in other places. So I said that London fell GDP terms, getting on for 10% last year. In Paris, the figure was somewhere between 8 and 9% on our Oxford economic estimates. In Frankfurt, Amsterdam, probably more like 5 or 6%. London does have some catching up to do, but it's moving in the right path. So this is a sort of summary of about 3 or 4 indicators. I've got loads more I could show you. I'm not going to take up your time doing so, but just showing very quickly 1 or 2 of them. So this, for example, is figures on employment using payroll taxes as a measure of employment. You can see the way in which it fell. You can see the way in which it's been trending up. Business surveys, the famous PMI survey, which is done for national economies around the world. We have the PMI for London. It shows the big crash at the time when the pandemic first broke, the big recovery, then drifting away, but now starting to pick up again. If you look at online job adverts, the trend there is favourable. If you look at people using public transports, both the tube, the subway, but also buses, a gentle trend upwards in that. Not so marked, but a gentle trend upwards. People asking for details on travel information, asking from Google, asking their iPhone how to get from one place to another. More and more people are making that question, asking that question, which is a positive sign. Loads and loads of those. As I say, I could carry on for a great deal of time showing you those sorts of indicators. But actually just as important are the underlying fundamentals. And the underlying fundamentals apply at the level of the global economy, at the level of UK economy and feed through to the London economy. And in the UK, something which is really important is that consumers have got a lot of money in the bank. There's a lot of money sitting there waiting to be spent. Whether people are going to be willing to spend, perhaps there's a question there, but there's no doubt that people have the money to spend. We're also learning how to live in this new world. Probably we're still going to be wearing masks for quite a long time, but we're getting much better at working out how to do business digitally. How to actually do a deal remotely is something that we're becoming better at. The government has been very helpful in the UK. We had a budget just a couple of weeks ago. Support programs are being extended to help companies, to help individuals through 2021. That'll be very, very, very helpful in terms of confidence. There's a new 2-year deduction for investment to try and encourage companies to go out there and invest, which will give the economy a boost. Brexit is there. It's very challenging for the UK. Most of the challenges have to do with manufacturing, and that doesn't really impact on London enormously directly. There is some manufacturing, but obviously it doesn't dominate the city. There's an issue about financial services, but it looks as if the deal for financial services is going to be done in a couple of weeks' time, as planned. Essentially, the EU and the UK have to decide that each of their financial regulatory system is equivalent to the others, system. And since they both are the same system, since up until recently the UK was part of the EU, that's what they will decide. So the financial services sector will be okay, at least in the short term. Our own forecasts at Oxford Economics are more optimistic than those of the Office for Budget Responsibility, which advises the government. We believe that they will move into line with us. That's what the Bank of England is already doing. So all of that is a source of confidence. I think there may be some problems in 4 or 5 years' time. I cannot promise if you invite me back in 5 years' time, I'll say exactly the same things. But at the moment, all of the evidence is on the upside. I could give you 20 slides on all of those. I don't have time for them, but I really do want to show you this one, which is that point about consumers having a lot of savings. If you look and see what happened to consumer spending in the UK in 2020, it fell by over 10%. Almost none of that was because people's incomes were lower. On the whole, incomes did not fall. It's because people decided not to spend money that they did have, which is why you get this big blue down spike in 2020. And we think that money is going to be spent in 2021 and in 2022. Not all at once. It'll take time. But it will come through as the underlying fundamentals improve. What does that mean for London? So that was a figure for the UK. Here's some figures for London. What this shows is output in London, GVA, GDP, year by year, and employment. See the big decline in output in 2020, see the big rise in output in 2021, and again in 2022. But note that employment in 2021, we think will actually decline further. It's not very big, it's not a big decline, but it's another year in which employment is going to be difficult. The reasons are that gradually as the economy recovers, the government will withdraw its support, and companies, employers will have to decide what to do, and they will need to protect their own finances, and probably, realistically, some of them will say, well, this is a good opportunity to do a bit of sort of reorganization, and it can let a few people go, and then in the fullness of time, come next year, we will take different people on. That's partly to do with the technology story, which I alluded to earlier. If you look at it sector by sector, the big pain in terms of absolute number of people comes, as you might expect, in the hospitality sector, hospitality and leisure. And that's because tourism will be slow to come back. Yeah, most of us, I think, will be pretty cautious in our decisions about where to go on holiday. And even if we're not cautious, then governments will be cautious on our behalf. So we're looking to see something like 37,000 people in that sector losing their jobs net in 2021, more than was the case in 2020. It's less than 10% of the total, however, for the sector, and it's a sector which is inherently very flexible, so it should recover. Another big decline comes in what we've called the usually office-based sectors, so finance, professional, digital, and so on. where there's about 20,000 job losses we're projecting for this year, 21,500 to be precise. It's only 1% of the total. There are 2 million people in that sector, or that group of sectors in London. 20,000 here or there, in the big picture, with all due respect to the individuals concerned, is not a big number. So office-based employment, the office sector in London, we think has some fundamental security to it. So those were the big issues that I identified. Online shopping, really, really important. If you're a major investor in Oxford Street at the moment, you need to think about that quite hard. And we're seeing that they are doing so. Plans to demolish the flagship Marks and Spencer store and change its use in its new guise. Working from home, this phenomenon that we're all part of, which will have an impact on the office market. Doesn't mean the end of offices, but does mean that some offices, I think, will lose and others will gain. And something that I do want to pick up is migration away from big cities. Because there was a big report in London, probably 2 weeks ago now, from a well-regarded economist saying that London in 2020 lost 700,000 people. The population of London declined by 700,000. We're doing the arithmetic on that. I think it's not 700,000, and I think that there will be a rebound. But just to give you some context for that, actually, it's not entirely a new story. Population in London has continued to grow in recent years, but the growth has fallen. For 10 years, London's population has been slowing. And the reason why London's population has been slowing is essentially because London has become more expensive because it's been so successful. So both as an individual, looking for somewhere to live, as an employer, looking for somebody to employ, London's become more expensive, and that's had a more or less inevitable effect. If we break it down, what we see is that in terms of the migration numbers, we've had a couple of years recently when London actually saw negative migration already. But notice that natural change, the difference between people being born, young kids being born, and people dying. Very, very positive for London. London has a very young population. London generates its own population growth through a high birth rate, a highly educated young population. It's a long-term fundamental strength of London. And this pale blue line here, there are not many cities across Europe which show this kind of arithmetic. And in terms of those migration figures, it's very important to think about who they are. These are figures of 2019, and what they show is that in London in 2019, the vast majority of people moving in were aged 20 to 24. Yeah, a big number of people moving in from elsewhere in the UK as well as from the EU, moving in at that age. And then in later life, they tend to move away. And what happened in 2020 is probably a few more people in their 30s, in their 40s and 50s decided that they were going to live out of London. But that's quite small. What really happened was that there was a temporary period when people who were going to move to London just decided not to just yet. They stayed living with their parents, they were leaving university, they stayed where they were. They were actually quite possibly being employed by a London company, but resident elsewhere. That's a temporary change, yeah. And we are reasonably confident that London will continue to grow in terms of population, and that's really important for the long-term prospects for the London economy. It's also quite important for the housing market. Housing is very important in its own right. Housing is also very important for consumer confidence. We need to be confident about the virus, but we also need to be confident that the home in which we live is not declining in price. London house prices did not fall in 2020. London house prices continued to rise in 2020. This is inner London boroughs, and you'll see that there are a couple of exceptions to what I've said, and the exceptions are Kensington, Chelsea, and Westminster, the two boroughs with the highest prices, the two boroughs that are best known globally. So they got quite a lot of attention when their prices were falling, but they were the exceptions. In other parts of inner London, prices rose. In Greenwich, in southeast London, prices rose by 8%. In Hackney, they rose by nearly 14% in 2020. The figures for outer London are very similar, continuing to see growth in house prices in 2020. Some of those boroughs seeing double-digit growth. And we think over the next few years, we'll continue to see growth in London house prices. And the reason is that fundamentally London house prices will be pulled up by rises in average earnings. And so we have as a sort of minimum forecast for house prices in London that at the very least they'll track earnings, and average earnings will rise by about 1.5–2%. I suspect that actually the story is going to be much better than this. That this is a safe conservative forecast for house prices in London, in inner London in this map, and in outer London in this map, both telling the same stories of the residential market in London continuing to be strong. And that's because the fundamentals for London are strong. The global recovery is here, the UK recovery is here. It's just about starting to happen. The rollout of vaccines will happen, it'll continue, consumer confidence will improve, government will continue to provide support, at least for the short to medium term. People have money to spend. The fundamentals of London remain very strong. It's the world's most important global city. It's not going to be quite as distinctive as it was 5 years ago, but it'll still be up there as a major player for real estate investors around the world. And the London population, I think, will continue to grow. I'm not moving away. Thank you very much.
Thank you very much, Richard. We will return with the questions a bit later, after we hear all the speakers. Right now, I would like once again to ask a question to Dmitry. Dmitry, after all we heard from Richard right now, and once again, remembering what we were talking about with you a year ago, can you repeat that London real estate market remains one of the most attractive markets for the investments, even more attractive than, for example, ETFs, which were and which are tended as one of the most stable, in the market, in the stock exchange. I mean, gold and other examples.
Большое спасибо. И спасибо.
Thank you so much, Ramaz. And I would like to thank Richard Holt for his wonderful talk. When I was inviting my friends and partners to our today's conference, I promised them that we would be objective. And I'm so happy to see Richard being objective about the situation in London. Back to your question, Ramaz. Yes, I'm still pretty confident about London's real estate market. And the information that Richard shared with us builds up my confidence, and especially if we talk about residential real estate that did not decrease in its price despite COVID-19 and Brexit, especially if we talk about short-term loans. If we have this nice foundation, then this business of ours becomes even more predictable and even more stable. In a nutshell, if we compare what we see in London's real estate market to other investment products, of course, we can speak about that for hours and hours and hours. But in a nutshell, if we take a focused look on some particular segments of the market that we work with, namely mainstream residential real estate or prime residential real estate, we'll see that it is a very resilient segment when it is hit by crisis, and we had so many crises hitting us lately. And it is nice to see that it is so resilient. it is so nice to see the results of our investment product that are short-term loans secured against London real estate.
To understand what's the main, I would say, volume of the London real estate market. Not even the value, but I mean the margins. How many buildings, how many properties are being sold, are being purchased, and so on and so forth. So this question I would like to ask to Helena. So can you please tell us what's the margins of London property market right now?
Sorry, good afternoon, everyone. So I'm going to, similarly to Richard, share a few slides. You may know, sorry, I'm going to share my screen. Bear with me. Can you see my screen right now? Yeah, right.
Yes. Yeah, yeah, now it's great. Yeah.
Good. So our job at MSCI is actually to create indices across asset classes, and one of them, or several of them, are real estate indices. So what I'm going to take you through right now is actually our landmark real estate index we have for the UK, which is an index we monitor on a quarterly basis. So it's called the UK Quarterly Property Index. So this index, is very big. We cover 235 real estate portfolios in this index, worth just under 150 billion worth of capital value, and it's got just shy of 8,500 assets in it, spread across the entire country. However, if you can read the numbers on the map here, actually this index is skewed towards London. Big in the broader sense of the term. London has got 38% of the total value, and the Southeast, which is also another great, a very active area, and which is in particular active because it's close to London. So, and this index is spread geographically, but also across property types. In terms of its property type value, it's got about 30% of it is invested in retail, 30% of it is invested in industrial, and just 25%, a quarter, in retail. The rest is invested in what we call alternative. Residential is one part of it. At the moment, residential is actually not a very big part of our index in the UK. We've got bigger shares of residential in other countries, but in the UK, for historical reason, institutional investors haven't invested that much in residential as they have in other sectors. However, it's probably one of the fastest growing sectors for institutional investors at the moment. So it's interesting. So that's the index I'm going to talk about. So something completely spread across the UK with a skew towards London, and across property type, but with a skew towards retail, office, and industrial. So returns in 2020, with the main return we measure for this real estate stock is what we call the total return. It's made of two components: the income return, so basically how much we get from the rent, and capital return, how much we get from the increase in the value of the building. So that's the long-term series from the beginning of the index to now. And you see it's been very volatile, with obviously a marked slowdown during the financial crisis in 2008, followed by a very strong rebound after that. And since then, actually, if you see the dots are the total return, so the sum of income and capital. And since 2009, we hadn't seen a single negative return. So we have been seeing an unprecedented growth for real estate, with over 10 years of positive returns in the real estate market, which really we shouldn't take for granted, because it is a very strong case for this asset class. However, in 2020, obviously with the pandemic, you see that total return for the first time since the end of the global financial crisis turned negative. In Q1, so because it's a quarterly index, we measure it every quarter. In Q1, it was actually 0, but it went then negative for three consecutive quarters on a 12-month basis. So that was 2020 was a really landmark for that. However, if we look at that in a little bit more detail, so instead of looking at the 12-month rolling return, we look at each quarter individually, and that's what I put in the little bubble at the top. You see already an interesting story, and which goes to back to what Richard was saying earlier. Q1, you see a strong negative return, despite income return in yellow being still positive. Most rents were coming. The capital values fell. Because it was such a shock, right? And in Q2, they fell even more, and therefore total return were negative. But in Q3 already, actually went back to a neutral total return, because capital return did fall a little bit, but the income return was enough to compensate for that. So what you lost in capital value, you could make it back with your income and be neutral on a total return basis. And in Q4, even more interesting, capital values, the blue line, barely fell actually. And so income, total return was positive thanks to the income return coming in. So 2020 was a tough year for real estate, even if we, in the context of the long term, but you see some different story even within 2020 with things coming back to being positive by the end of the year. One thing though this chart doesn't show is the difference in performance across property types, and that's absolutely fascinating in this chart. So you see this is the total return, 3-month total return for the all index, the dashed dark curve, but also for each property type, right? And you see that over time, if you start back in 2001, actually the total returns across asset property types differ, but fundamentally they follow each other, right? Very closely. I mean, the lines are hardly readable if you look at that, except if we focus on 2016 and after. 2016, you see this big dip, and 2016, this big dip is the Brexit referendum. It really marked the real estate sector. There was a very sharp contraction, very short-lived, but it was there. But what has changed, though, is the fact that the property type started evolving differently, right? It definitely did something to the property market. And what you see is that the blue line, the navy blue line, is the retail assets. These retail assets have actually struggled to recover properly. And in fact, the total return of retail has gone down since 2016 quite markedly, and has been negative, in fact. On the other hand, on the other side of the spectrum, you see the industrial assets. And by industrial, we mean in particular, well, so there's a lot of things in industrial like manufacturing, but there's also logistics centers, right? Distribution warehouses. And these, you see the teal bar, have been incredibly popular. So over time, they've always been there, and they've always done a good job, but they've never been spectacular. But since really in the last 5 years, they've really completely changed, and now they're incredibly popular. This is true in the UK. This would be true anywhere in Europe. This asset type is becoming more and more popular, and really the returns of this asset class is completely different from the rest. And in fact, if we look over time, you see that the gap between the best performing segment, industrial, and the lowest performing segment, retail, is at its biggest. There's a difference of 8.5% between industrial and retail. So basically, if you're real estate investors, you will have a completely different experience if you invested in industrial or if you invested in retail. That's a completely different story. So it's very hard to talk about real estate as a whole now. You need to dig into it and look at which sector. The two I haven't mentioned, but they've been mentioned already, is offices and residential. Office is the yellow line. Actually, office has done really well. It's never been a stellar, in the last 5 years, hasn't been a stellar property type, like for example industrial, but it's always returned really well. It's been stable, above the average, and quite good really. However, in 2020, 2020 was difficult for offices, and for the thing that Richard mentioned, working from home and bringing uncertainty to what offices are going to do in the future. Also, now we tend to forget about it, but Brexit is now done and we've got a deal. But until the end of 2020, no one really knew what was going to happen. And that, again, was yet another factor which added to the uncertainty of the office sector. So it's done really well, but 2020 was a little bit difficult for offices. So if we zoom into each segment in a little bit more detail, so here what I put is the main 4 sectors that I mentioned earlier on a 12-month basis, and then on the right-hand side I put the 10-year return. I won't spend much time on the 10-year, but still it's nice to have in mind. So if we look at the segments in detail, it's pretty easy really what's happening. Industrial was the best performing segment in 2020, and frankly, any type of industrial would do, right? It was just strong, whatever you chose as a type of industrial. On the other side of the hand of the spectrum, you had retail, and we know why retail, as you can see, is struggling, has been struggling, and we know why, right? Online shopping has been now a theme for a number of years, maybe 10 years or so, and obviously it's hit a number of real shops, right, brick and mortar shops. But of course, 2020, think that most of these shops were actually closed, right? So imagine it's been difficult for this sector. However, there's a noticeable difference, an exception, which is supermarkets. You see these blue bars here. Supermarkets, it is retail, but actually, thanks to the pandemic, supermarkets remained open. And actually, that's one of the few things that people were allowed to do, to actually spend money on food. So supermarkets did incredibly well in 2020. The other sector that did incredibly well is healthcare in 2020. It was a strong sector to be in. So it's part of the alternative sector. And it did well. Residential, Richard mentioned, residential has been doing well, actually. It's been a tough year for real estate, 2020, but residential held quite nicely, 3.5%. And actually, I'll go back to that in a bit more detail. Offices was a bit more mixed. It really depended what sort of office you wanted to look at. And I'll go back to that. However, that's 2020, a little bit difficult, depending on which sector you were in. But over 10 years, this is a very strong case for real estate. You see that the returns on average was 6.9% over 10 years. So 6.9% every year for 10 years is very strong. Industrial and offices and residential all did extremely well with returns over 8%. The weaker sector was retail for not really the pandemic this time over long term, but for online shopping, the way people are changing their consumption habits. So that's clear. And in particular, there's only one segment which actually over 10 years showed a negative total return, and it's shopping centers. So shopping centers has been suffering a lot, again, due to the pandemic, but even before that. And it's because the consumption habits are changing, and it's very difficult at the moment for shopping centers as a property type. So if we spend 1 minute on central London in a little bit more detail, so that's a 12-month return for central London for the offices, and I split what I wanted to show is central London compared with the rest. So offices in 2020 show a slight negative, -1.7%, but actually that's temporary. It's been doing really well before that. But if you look at it by region, there are differences. And central London is in navy blue. Central London did really well after the global financial crisis because there was a strong economic rebound in the UK. And obviously central London is very exposed to economic activity, so did really well. Following Brexit, Brexit referendum in 2016, central London offices has slowed down a little bit compared with all offices. And it's because of the uncertainty that the Brexit referendum brought on the table, really. And so there's a little bit of a slowdown in central London compared with the other other region. However, it's still a positive return, obviously, before the pandemic. Another focus I wanted to do is on residential. So on residential, here I just changed sample. Instead of looking at our quarterly sample, I looked at our annual sample, which is not as regular because we only measure it once a year, but actually it goes back much farther, since 1990, and also it's got a bigger share of residential. So we've got more assets in this sample. And here it's a good story for residential. What you see is that total return, the red dots, have always been positive since 1990. So we're talking 30 years, right? 30 years of positive total return in residential sectors, with the exception of 2 years, 1992 and 2008. 2008, obviously, it's the global financial crisis. Every segment suffered, and residential did too. But in 2020, even if capital returns, so the values, turn negative for the third time in its history, actually, the total return for residential sector was still positive thanks to the income return, right, which is just the rent coming in. So it's a very strong story for the residential sector in the UK here. If we zoom in to 2020 only for the residential sector, and we split it by region in the UK, then we see an interesting story, in effect, a simple one. So overall, that was a positive return, 1.5%, thanks to...
В целом, мы отмечаем, что общая доходность сохранялась в положительной динамике, кроме двух регионов. Это центральный Лондон и внутренний Лондон. Все остальные регионы демонстрировали куда более приятную динамику. И на самом деле это отражает то, что Ричард сказал в своем выступлении. За год очень тяжело смотреть показатели и делать какие-то долгосрочные выводы. Но, тем не менее, даже если мы посмотрим вот на этот годовой график, то мы видим, что на большинстве территорий общая доходность сохранялась в положительной динамике. Если мы посмотрим на внешний Лондон, здесь жилой сектор замечательные результаты демонстрирует. Если вы инвестируете в недвижимость, важно смотреть и на такой показатель, как вакантные площади, увеличение или уменьшение их доли. В общем, мы видим существенное увеличение доли вакантных площадей в июне. Это сказалась пандемия. В июне даже по сравнению с весной вакантные площади увеличились очень серьезно. Тогда был введен жесткий локдаун. Если мы посмотрим разбивку по секторам, то все секторы пострадали от борьбы с коронавирусом, кроме промышленного сектора. Там в июне был небольшой рост.
The biggest driver for this vacancy rate has been the office sector. If you see the yellow bars, between March and June, there was quite a significant jump between 11.3 and 12.8. And of course, we know what it's about. It's about the working from home, the fact that some offices, some of them who could vacating some buildings, at least on a temporary basis. And if we zoom into London offices vacancy rate, to offices vacancy rate in more detail, what we see is that what drives this increase in vacancy rate in the office sector is London. Right? So London, London City and London West End are the two blue lines on your chart, and that's the vacancy rate. Yeah? And you see the sharp increase in both blue line, okay? And that tells you that the office vacancy rate was driven by central London. Actually, if you go outside London, rest of South East, rest of UK, the green line, yes, there was a little bit of an increase, but then it goes back down after that. So it's really central London that was impacted by this increasing vacancy rate in 2020. Again, for reasons we know very well. Finally, the last metric that I wanted to show you is actually something I don't usually look at, but it's particularly interesting in 2020, is the net operating income growth. So what it is the growth in rents, right? Rent that have come in. And you see that net operating income growth over 12 months rolling on the left-hand side. If we go back to 2001, it's always been volatile. But it's been volatile between -3% and 3%, or -4% and 4%. But see 2020, it's a new world, right? All of a sudden you see this net operating income growth just dropping really sharply. And what it shows is that obviously a lot of people struggled to pay their rent in 2020, and therefore there was just some rents did not get paid, basically. And so that's what it shows. The biggest was in the retail, but which drove that. But it's very marked, the fact that rents struggle to come in 2020. We very much expect that this will be seasonal, and already, in fact, if you look on a quarter-by-quarter basis, that's on the right-hand side, you see the seasonality already. March was neutral because in March it was too early, the pandemic had just started, but June is when rents stopped coming in as much as before. So you see this negative NOI growth, and then September it stabilizes already, and December it goes back to positive. So going back to what I was saying earlier, the fact that 2020 was difficult, but actually already in Q3 and Q4 you could see an improvement. This the way the rent growth could show that quite nicely. Already in December, rent was growing again. So another thing which was interesting in 2020, although it has started before, is activity. So these show the activity in our index, or in real estate. And activity is basically the buying and selling, right? How much changes hands and how much money is deployed in the real estate market. And what's been interesting is that the long-term activity is measured with turnover, and the long-term turnover rate or activity is 18%. But look at 2020. You see this really low activity. And what it is that in 2020, because the situation was so difficult and was so difficult to read in particular, very, very few sales or purchases happened actually in comparison to what we saw in the long term. And it's because the situation was abnormal, and it's very difficult to trade in abnormal times with very little liquidity going on. So 2020 was very special for that. The activity was at a low on record. So finally, to finish on a positive note, although 2020 was not all negative, and I hope you got that from my presentation, but here what I did is compare real estate over 1, 3, 5, and 10 years with other asset classes, and in particular, equities and bonds. And yes, over 1 year, 2020, real estate was negative and was much lower than bonds, even though it actually beat equities. But if you go over 5 and 10 years, actually, real estate remained the best asset class, best performing asset class, behind 10 years behind equities and bonds, and over 5 years was very close to equities and bonds. So it's still a very compelling case for real estate as an asset class, even if 2020 was actually a difficult year.
Thank you, Helena. Thank you very much for your presentation. I will kindly ask you to switch it off. Yes, thank you very much. And well, we saw the total picture of commercial and residential real estate in London. And due to all these problems, I want to know what's the price now for, let's talk about commercial real estate in London, in different districts of London, and about sums, about these numbers. I would like to ask Mark Stensfield to talk just a bit more detailed about it. But and I will also kindly ask all the speakers to be a little bit more brief, just for us to have time to ask questions to you. Thank you very much. Mark, please, you're welcome.
Thank you very much, and good afternoon, everyone. Hopefully you can see my slides. So yeah, I'm going to talk about some of the latest trends and forecasts that we've seen in our data since the pandemic began, and obviously looking ahead over the next 5 years. I'll start with the London office market update, look at COVID-19 impacts and forecasts. Then home in very briefly on the retail market, and finally end with a spotlight on Oxford and Cambridge, which have done pretty well since the pandemic began. There's a lot to cover, and I've got quite a few slides, but I'm going to whip through them very quickly and just really illustrate the key messages. So the first thing to say at the outset is all this analysis is drawn from the granular building level information we collect at CoStar and track on on an ongoing basis. So 106,000 buildings in London alone. And by aggregating all of these buildings, we can see that London's office vacancy rate has risen from its pre-pandemic low, particularly in the second half of 2020 as net absorption turned sharply negative, as you can see in orange, and there was an influx of new deliveries. London office vacancy sat at a 4-year high at the end of last year, albeit still well below 2009 levels. This varies by market. A lot of that extra supply delivered in the City of London, helping to push the vacancy rate in London's financial heartland up to a 9-year high. Conversely, the West End recorded a far more modest rise in vacancy last year. Now, one of the reasons behind rising vacancy is that tenants have attempted to offload surplus space as they pivot to home working. London's seen a far sharper rise in sublease availability than the rest of the UK, a 46% increase year over year versus a 15% elsewhere, as the cost of space in London combined with the difficulties of tube travel. However, early signs from 2021 suggest this trend is abating as firms pivot to thinking about the space they need moving forward rather than what they don't need. So home working and pandemic uncertainty has also led to a sharp drop in office take-up, with renewed lockdowns over the winter, preventing any real bounce back so far. Now, leasing has never really slowed to this extent during downturns, as leases expire regardless of the economic cycle, but anecdotal evidence suggests that firms have been agreeing short-term lease extensions rather than signing new leases in the current climate. But deals are still happening, with more than 1,200 agreed across London over the past year, and more than 60 of which were over 20,000 square feet. The blue dots are those deals, and I've highlighted a few examples. Media firms like Netflix and TikTok and Twitter have agreed sizable deals in the West End. Some big law firms have committed to pre-lets in the city, like Baker McKenzie and Latham & Watkins. And Waypoint Capital recently signed a big deal in Mayfair. And in terms of deal activity, it's the core West End markets of Mayfair and St James's that have stood out. This chart shows deal counts in Q2 to Q4 last year versus historic norms. And those areas have outperformed, as you can see by the blue dots, as have areas beyond central London that are less reliant on tube travel. That said, some firms have proved willing to pay sky-high rents for the very best space, even during the pandemic, emphasizing the enduring appeal of offices in the best locations. Witness the world record £277.50 rent paid at 30 Berkeley Square in October last year, with the reported £110 per square foot for top floor space at the Leaden Hall building on the right, a record for the city. So while rents have started to drift downwards across the overall, firms willing to pay for the best space. That's similarly the case on the investment side, with investors willing to pay well and pre-pandemic prices for core well-let property, which has become more attractive over the past year in relation to government bonds and prime offices in other major European cities. London remains a key destination for global capital, and increased spending in recent months has been driven by that global capital, international investors. And here are some of the key deals. And that focus on prime can be seen in record averages being paid for deals that have concluded, despite overall levels of activity slumping to a 10-year low in 2020. That has continued into 2021, the price per square foot increasing further, albeit based on a limited number of deals so far, so something we'll continue to monitor. In terms of the areas most popular with investors right now, here's a heat map from CoStar showing the hotspots for investment. Lots of activity in Mayfair and St James on the left there, which is often seen as a safe haven in times of trouble, as well as close to the new Crossrail station in Farringdon in the middle of the chart. And it's worth noting that investment activity is increasing, with a big jump in Q4 that stands in contrast to continued declines recorded in New York. Now, London tends to bounce back more quickly than New York in previous downturns, as you can see by the green circles. But that bounce back in London is now underway. Knight Frank reported in February that £46 billion of global capital was targeted in London offices this year. So London remains as liquid as ever. So that's what's happened. What about the forecast? Now, London's employment outlook has worsened. Richard talked about this in more detail, but this compares Oxford Economics September 2020 forecast with December. And you can see that more jobs are likely to occur this year than last year, before a rebound in 2022. And it's these projections that influence our demand models in CoStar forecasts. And here's the base case outlook then for London. Office vacancies are expected to continue rising until mid-2022, in line with relatively weak demand and another busy year for deliveries. But a rebound in demand and a slowing pipeline thereafter should bring them down again from 2023. And this is what that would mean for rent growth. Rents have not moved too much so far, but losses of about 8% are expected over the next couple of years, softer declines than during the financial crisis, before recovery to current levels by 2025. And this is the average, of course, across the whole market. And we also produce a range of scenarios to help clients navigate through the uncertainty. And here's the severe downside scenario, which predicts a sharper rise in vacancy amid a weaker economic recovery and reduced demand for office space before vacancies come down again from 2023 onwards. Now, that scenario would cause a sharper and more protracted decline in rents, of course, with rents declining by more than 15% and not recovering lost ground. And that's, of course, the severe downside scenario. But recent news makes that scenario perhaps less likely, with the successful vaccination program creating upside risk. The UK is well ahead of its European peers in that respect, which should lead to a faster reopening of society and the economy and a speedier recovery. Here's the latest roadmap, with all restrictions due to be lifted by mid-June. Now, the flip side to some of that optimism, or the extra layer of uncertainty, is to what extent home working will return or will persist when restrictions are lifted. Now, this is being hotly debated right now, and here's some interesting analysis done recently by CBRE that factors in de-densification, as well as peak occupancy analysis. If people work 3 days a week, everyone will need to be in there on Wednesday, for example. So that has implications for office demand. And they estimate in the round a 9% drop in overall demand. Now, this will be on the mind of a lot of CEOs right now, especially the more than 2,400 that have office leases expiring in the next 12 months, as shown here by CoStar's leasing data. Now, anecdotal evidence suggests that firms will want high-quality central hubs to attract talent, welcome clients, and collaborate, even if taking less space overall. And that's matched by our forecasts that suggest that demand will bounce back faster and more strongly in prime or 4- and 5-star rated buildings in our database. And this is in line with previous downturns when firms chose to upgrade their space in anticipation of the wider economic recovery. And this flight to quality will likely create some dislocation between prime and secondary vacancy rates moving forwards, with permanently high vacancy rates in older buildings that could lead to more offices being redeveloped or repurposed into other uses. Again, this is another chart in the database. And finally, here are our forecasts for London office yields. Only a minor upwards movement is expected in the near term, and London offices should remain attractive compared to government bonds throughout the forecast. Average prices will likely dip by around 13% in our base case as yields tick up slightly and rents fall, but recover from 2023. But this is the average, of course, with some assets and locations well placed to outperform. So moving swiftly on to retail now. Now, London had been weathering the retail storm better than most areas before the pandemic, but a few charts will show that this is no longer the case. We can see it in leasing, which plummeted to very low levels amid multiple lockdowns last year, far weaker than in 2009, for example. At the same time, availability rose sharply, reaching a 9-year high at the end of last year. And Oxford Street has been a microcosm of retail struggles of late. The flagship stores of Debenhams and Topshop closed, joining the likes of Forever 21, HMV and BHS as mid-market retailers struggled even before the pandemic. Now, Oxford Street's future is likely to include a broader range of uses, including entertainment, co-working, food and showroom space. House of Fraser, John Lewis and Marks and Spencer's will be partly converted into co-working space. The former BHS department store is now a swingers, crazy golf centre and a food hall. And mixed use is certainly Reef's plan for Cavendish Square Gardens to the north of Oxford Street, where an underground scheme combining medical, retail and leisure space is progressing through the planning pipeline. The Bond Street, Regent Street and Covent Garden have seen smaller shop sizes and a higher proportion of more resilient international or luxury retailers, so they've been less impacted by the crisis so far. The speed of London's retail recovery will also depend upon the return of office workers and international tourists, of course. This is mobility data showing that London has suffered disproportionately in terms of footfall, and with 80% of London tourists being international and the return of long-haul travel unlikely anytime soon, the recovery of London's retail market might be a fairly slow one. Quick word on Oxford and Cambridge, which David highlighted in the last webinar as attractive markets, and the data bears this out. We can see it by looking at office leasing last year relative to stock size, where Cambridge comes top of all the 55 office markets we track across the UK. Cambridge has become a centre of life sciences and tech, sectors that have done well during the pandemic. And this is creating a surge in demand for offices there. Here are a couple of recent stories in CoStar News highlighting this fact, with competitive bidding pushing up prices in nearly all cases. Similar story in Oxford, with investors and developers very busy in knowledge-based cities with strong university links. So, quick summary, the vaccine programme and economic recovery is to boost office demand from H2, with firms to pivot to high-quality offices, even if taking less space overall. The vacancy rate's likely to peak in 2022, and average rents to fall by around 8% in the base case. As we've seen, tenants, investors are paying well for prime. On the retail side, Oxford Street is challenged, and a slow high street recovery geared more to leisure. And knowledge and life science focused markets likely to outperform. And of course, it goes without saying that access to accurate, comprehensive and timely data has never been more important. And we have a wealth of charts and reports in CoStar to help clients navigate that uncertainty. So that's the end of this whistle-stop tour. I'll now hand back and for David's final comments.
Thank you, Mark. Yes, as you said, now I want to ask David and return to London and speak about London real estate. Once again, David, I have searched through your site and saw your objects. Of course, I stopped at King's Road Snow White building, as it is nearby my beloved Stamford Bridge. Used to live and study a little in Parsons Green while being a schoolboy in the early 90s. And ever since, I'm a Chelsea Blues fan. But I wanted to ask you this question. As far as I know, next year a new Elizabeth line of modern Crossrail is going to be launched. It's considered to be one of the major construction projects in Europe. How would it affect the development of London real estate? Do you take into consideration this project in your search for new objects?
Indeed, and thank you for the introduction. It's my task now to bring the seminar to a close with some real-life examples of where we think the property market is going and some opportunities which we think the savvy investor should follow. So, I think the first thing to say that it's always difficult to find value in a tricky market. And in English, we say it's like looking for a needle in a haystack. You know there's some little gems out there, but finding them is really tricky. But the three themes we want to cover today are recovery, regeneration, and research. I want to guide you and our audience through the what, the where, and the when. Of course, the first question to answer is, will real estate recover? And our central scenario, based upon what our colleagues at Oxford Economics say and what we can see in the market generally, is that there'll be mass immunization by the end of Q3 2021. Markets will soon begin to recover once the vaccine is rolled out. We're more pragmatic than Mark, perhaps, and we think the demand for offices will rise quicker. And we certainly agree with Richard, there'll be a large discretionary spending increase on leisure. And taking all that together, we think that demand for retail and restaurant units will re-emerge. And being a pragmatic optimist, I can now see the sun shining, the cherry blossom is out, and personally, I've had my own vaccination, so life is looking a lot better and a lot more positive. I think the first question to answer about London, or to explain, is the great resilience the city has. And in my long working life, I've seen two examples where the doomsters and the gloomsters forecast the end of office occupation. But in fact, in both cases, London recovered really quickly. The first, of course, was post 9/11, when the Twin Towers went down. The immediate response of the commentators was to forecast the death of cities, the end of multi-story office buildings, the end of high-rise, and falling values. But actually, none of that really happened. The second big shock to our system was the global financial crisis post-2007. Again, this time the forecasters were predicting the death of financial and banking services, the end of large floor plate offices, and falling values. But as we'll see, that didn't happen. I've taken this slide from one of LN's slide decks, and it shows the capital values, the total returns of London offices throughout these cycles. And you can see here that after 2002, values fell but quickly rose again. And after 2009, they fell but quickly rose again. So we take heart from these historic figures and look forward to a more positive outcome going forwards. And my optimism is not just based on charts and figures, but on hard bricks and mortar. And here you can see two photographs, the first taken just before 2002 of the London skyline, and the lower photograph shows London today. You can see the dramatic rise in office buildings, apartment blocks, etc., etc. We have seen the recovery and the densification of London. And what about tourism? Again, despite these huge shocks we've had over the past 15 or 20 years, the number of tourists have doubled over 18 years. International tourists bounced back both quickly after 9/11 and after the GFC. I know from my own personal experience that my wife and my kids are desperate to travel again to Europe, and I'm sure there are many Europeans and those beyond who are desperate to come to London. So as we look at the themes going forwards, our first is recovery. And we are targeting areas which have been particularly impacted by the pandemic. These are the tourist areas of Soho and Covent Garden, where a lack of consumers has seen falling rents and higher vacancies. But we think that this is short-lived and that tourism and office workers will soon return. So we are targeting for our clients vacant shops and vacant offices. The second general theme that we support is regeneration. And it's clear that there are substantial locations and areas where vast amounts of central government money is being pumped into the economy. So we've got both central government investment and private initiatives, all aiming to improve transport links, which will increase the population and increase demand for commercial properties. You mentioned in your introduction just there the Elizabeth line. This is the Crossrail line, which will connect Heathrow in the west with central London and then Canary Wharf and eastern London. This is a huge new engineering undertaking where a new tube line has been built under central London. The tunnels have been built. The hardware and the IT is going in place, and we're looking forward to opening in 2022. This will dramatically improve the connectivity of certain central London locations. And Mark mentioned Farringdon as one of his current hotspots, and we certainly agree with Mark. Farringdon would be the only location which will have an east-west and north-south connection. But it's not just central London that's benefiting from these government infrastructure projects. HS2, which is our new high-speed rail line, is now under construction. This will link London with Birmingham initially, and then with the northern cities of Manchester and Liverpool, and eventually Leeds and Sheffield. Phase 1 is due to open in 2029 to 2033, with Phase 2 opening a decade later. Now, there's been lots of debate in the UK about the value of this, but our Prime Minister Boris Johnson has decided to go ahead, as it's a shovel-ready project. In addition to central government spending, private sector is often fully behind large-scale brownfield projects. This is where local authorities will use their planning powers to open up opportunities for private investors to come in. And these are not just pipe dreams, they're happening already. In the west of London, Old Oak Common is forecast to produce 25,000 new homes, plus HS2 and Crossrail stations. Whilst in the east, Woolwich is due to have 5,000 new homes, over 40 hectares, and a new Crossrail station. And before I leave you, my last theme for today is research. So we see an arc from Oxford to Cambridge, which takes in our two great universities as the new golden arc, the new golden triangle, if you include London as well. This area focuses on research, but specifically on medical, where of course its importance has been emphasized and magnified by COVID. Artificial intelligence, robotics, electric cars and batteries, and motorsport. Mark has mentioned the popularity of Cambridge as a market and the number of deals that have happened on offices there. But the Arc is a much bigger location, and it stretches over 50 miles, over almost 100 kilometers from east to west. The government sees this arc as being a huge area for growth over the next 30 years. It sees locations for garden cities with a housing target of over 1 million new homes. And the infrastructure is already going in. The reopening of an old east-west line between Oxford and Cambridge is underway, with the first two sections either open or built already. So in my brief time to summarize what my colleagues have been saying, I'm a pragmatic optimist. I see more hope in the future than we've had over the dark 12 months of the past. I believe firmly that London is a resilient city, and once again it will recover. And our three themes for the future are recovery, regeneration, and research. Thank you.
Thank you very much, David. Now it's time for questions. And first of all, I would like to ask Richard, as we are holding this conference both for Britain audience and Russian audience. So let's focus on possible Russian investors. unexplained wealth orders, UWO, is the new law which was implemented not long ago, plus not very warm relations between Downing Street and Kremlin right now. How can all this reflect, from your point of view, on the attraction of Russian money into London into London economy, and in particular, London property market?
I'm afraid that's not an area of expertise that I can help you with. I think you need to ask other people about that. I'm very happy to talk to you about the prospects for the economy of Hong Kong or New York or London or Birmingham, but Anglo-Russian relations is not my strong point. I'm sorry.
Okay, let's take aside politics and focus on just on economics and on finance. Do you see Russian money in London? Let's put this question. Or it is hidden behind Hong Kong money, US money, and all other monies, Chinese first of all.
Yes, I mean, the whole world invests in London. I'm doing a similar event for this in Hong Kong in 3 weeks' time. I've done similar events in Tokyo, all remotely, of course. As far as investment is concerned, from where we are in London, it's people invest in London for the same reasons. What is true is that I think probably 5 years ago, it was so obvious that you should invest in London that you didn't really need to think about it very much. I think going forward, that's much less true, and it's much more important to think about what are the relative merits of London compared with Frankfurt or Berlin, what are the relative merits of London compared with Edinburgh or Birmingham. And those are the key questions that investors need to be asking. What is special about London is always the question that you should ask yourself, rather than I wonder where other people are investing, because if that's your starting point, then you're probably behind the curve, and that's not where you should be. Make up your own mind, assess one particular asset class versus another, one particular city versus another, make up your own judgment based upon the experts who you employ to give you that advice.
Thank you. Dmitry, maybe you have what to say about Russian investors in London. How are they feeling right now there?
Это несомненно.
Well, I think Russian money is coming to London. I really liked what Richard said. It's not easy today to say that London is going to be so good for investments. The devil is in detail. London is great, but is it really that great for investments? What class of assets is the most lucrative? That's what we have to, well, decipher for us. We need to have someone to guide you, and an expert team, an expert company with all the competencies which can give you the best kind of advice, having done proper analysis of the situation and the market. Now, let's come back to the first part of your question. I can tell you that, well, yes, we see Russian investments coming, and there is a plethora of reasons why that happens. And I think that my wise colleagues have said it all. Outer London, in terms of the residential real estate, is going to be supported by Crossrail and other similar links, is going to be going up in terms of its value. So it's a positive trend, and it's a good point to invest your money in. Of course, it would require a certain reconfiguring of your mindset, yet retail is going to be, again, a very lucrative point of investment. Once the vaccines are rolled out in full and all people are inoculated against this COVID-19 infection, then people will be coming back. People will again want to have quality of life back. And Mark mentioned the high-end offices and their prices are going up. I agree. Right now, I'm more positive about my future than yesterday. And I would like to thank my colleagues here on this webinar for that. So thank you for giving all that hope.
Let's now talk about your instrument, which the investors, potential investments, can use to search and to operate in London. I mean, right now, London Credit Fund launch. What is this, and how can it help potential investors, including Russian investors?
Необходимости, жизненно важной
Well,
необходимости
first and foremost,
внимания к деталям.
you need to pay attention to the details. Details are key. There is no silver bullet. There is no one magic pill to cure all diseases. So there is no answer to the question, what is the best way to look for something to invest into? Each and every investor is unique. Their profile is unique. Their portfolio is unique. You have different appetites for risks and for returns, for ROIs. Well, you know, it's one thing to be a person who is about to retire and a different thing to be a young, vibrant investor. They will have different kind of appetites, different kind of goals. So the only way I can answer your question is to, well, be cautious, be careful, find an investment specialist, an expert, assess all the factors and choose the best value for you. Find the best strategy. Pursue this best strategy. Consulco has a number of products to offer, and we have individual, tailored formats as well, which can help you find an exclusive solution. We have a range of offers, actually. We can offer some more, interesting things like David King deals with. It's commercial real estate, that, golden triangle, Oxford, Cambridge, London. It's also good. And then we have such interesting things as London Credit Fund. It's a fixed income fund. It gives you quarterly dividends. It's a multi-product, multi-currency platform. It is secured against real estate, and real estate is a wonderful asset. And I mean outer London in particular, because, well, today we've spoken about it a lot, and I think everyone knows that it's a top-notch asset. On our part, we are ready to find the best solutions for you. We are ready to give you tailored solutions to build the best trajectory for your investments going forward. Something that would suit your needs, your goals, your profile. Something that would give you the best possible results.
Thank you, Dmitry. My next question I would like to ask both to Helena and Mark, because it concerns your presentations. You said that, as far as I understood from those files, that the recovery would be very different depending on different sorts of commercial of businesses. Yes, the industrial will recover more quickly. Offices would recover more slowly. So can we see the transformation of real estate from offices to industrial, or in the needs of electronic commerce, which will blossom, and which is right now blossoming, and which will continue this recovery and this increase. So what will be the London market, real estate market, in very near future from your point of view? I mean, these types of businesses of industrial and commercial use. Helena, you first.
I mean, I don't know in terms of the numbers of the forecast. We're not even allowed to do forecasts because we've got the information, but certainly we've seen already a really drastic change in retail versus industrial. You said it. And if we look 10, 15 years ago, 45 to 50% of our database was retail, right? And today it's 25. And what it is, it's not really sales, it's the values of the retail that has dropped. And what was it replaced with? Alternatives, the like of residential and leisure and data centers are starting, right? But also industrials. And by industrials, we mean the new breed of industrials, the logistics centers, which are extremely techy, right? They're full of electronics in them, because you can imagine it's a distribution warehouse, it's very sophisticated. And so that's why you see the migration between the retail, the shopping centers, the old school shopping centers, which are less and less popular, and this new breed of logistics centers, which are very high tech and extremely popular. And it seems that there's never enough money to buy these centers at the moment. There's just what people want. And I think that's going to carry on just because of this change in habits. I think it's inevitable. For sure.
Thank you. Mark?
Yeah, just to add to that, I mean, over the last 10 years, we've seen a lot of offices being converted to other uses, hotels, residential, student accommodation, since planning relaxations were imposed. And yeah, the pandemic will likely accelerate that, whether it be offices, being changed into residential use, or especially in perhaps town centres, and yeah, retail to industrial as well. We've seen a couple of examples of retail parks, for example, being bought for conversion into last mile logistics in and around London. So that's likely to be a theme. And yeah, it's likely that shopping centres will be demolished, some will evolve into mixed use schemes with greater leisure quota, more residential space to bring people into town centres. Or so yeah, the pandemic is going to accelerate that. There were some planning relaxations imposed last September, which should make this easier for owners to convert property into different uses. So absolutely, that will be something to monitor moving forwards. But obviously, there will be opportunities there for investors to buy assets, repurpose, and make decent returns.
Thanks a lot, David. One more question for you. During today's conference, we mentioned several times about the migration, which is one of the significant factors of the changes which are happening right now, not only in London, but in the UK on the whole. So this migration, this changes of the, if you allow me to use this quality of population, yes, which is getting more young. So how would real estate reflect these changes from your point of view? Mostly through the way of residential real estate increase or commercial real estate increase?
I think you've exactly highlighted the two big themes of a younger population. The first is the need for more but smaller flats and apartments, both in the central area and in the suburbs as well. And certainly, we have seen significant construction of apartments, of residential over the past 10 years, but it's nowhere near enough for the demand. And the consequence of that is higher rents and higher prices. And I think the second element on the commercial side, with a young growing population, is a demand for leisure uses. And what we've certainly seen over the past 12 months is a real desire from the younger generation to mix and to meet, to socialize and to have fun together. And in our themes of recovery, we're looking at the London leisure locations like Soho, like Covent Garden, as being locations where people don't go just to shop. They go to meet, they go to eat, they go to see their friends and have a drink. So I think those two themes, residential and leisure, are the ones to draw out from your migration, your initial question.
Thank you, David. I hope that that we created a very very sharp portrait of today's London real estate market. And the investors who didn't know what is going on right now in London and in Great Britain on the whole, they got some answers on their questions. Dmitry, maybe you have something to add as a conclusion for our today's conference.
I would definitely like to thank all our esteemed colleagues who have participated and made their presentations. Во-первых, обязательно я хочу сказать огромное
I also
спасибо
would like to thank
Ричарду и Эллен, и Марку,
Richard,
и Дэвиду
Helen, Mark, and David
за исчерпывающие презентации
for
и
their detailed
очень подробный анализ, который
talks
действительно,
and for their
Ромас, я согласен,
insight
реально
and a
дал
very
нам
thorough
сегодня
analysis of
хорошее понимание,
London's
что
real
происходит,
estate market. They gave us
обоснованное
such a
и
good understanding
позволяющее
of
нам
what is happening today in London and
получить четкое
across the UK
представление
as a
о
whole.
ситуации,
We now have
трендах
a very clear idea of the current situation in London, of the current trends,
и основах, на которых мы можем, в
and I
принципе,
believe now
делать какие-то выводы.
see what they
Похоже,
can
что
start
Лондон
with.
наиболее
in London.
устойчивый, стойкий
It seems
город
like
с точки зрения
London is
потенциала
a
для
very
восстановления
resilient city when
по
it comes
сравнению со
to
своими
facing challenges.
международными коллегами.
And I
Мне было
think London
интересно увидеть
has a
слайд про
greater
Нью-Йорк.
potential for recovery. I was very interested in the
Это раз,
slide
и два,
comparing
что,
London's
как
recovery,
Эллен
investment recovery
указала,
to that
если
of
смотреть на отрезок
New
10
York.
лет, то именно
And if we
недвижимость
look at the
является наиболее
10-year
стабильным,
perspective, as Alan has said,
эффективным классом
real
актива
estate
для
is the
инвестиций.
most safe class of assets.
Во всяком случае, абсолютно очевидно, что тема архиинтересна, и я очень надеюсь, что наши слушатели получили пользу, позволяющую рождению определенных идей, возможно, решений, желаний. И мы со своей стороны абсолютно готовы и рады спокойному обсуждению всех тем, в которых, конечно, мы можем быть полезны и которые интересны нашим уважаемым инвесторам, партнерам, друзьям и коллегам. С моей стороны огромное спасибо всем. Берегите себя и будьте здоровы.
Thank you very much, Dmitry. And I would like to say thank you to Consulco Group, which helped a lot to organize today's conference. And we all understood that despite all the problems, all the global problems, which are actual nowadays, I mean, mainly pandemic and Brexit, London remains one of the major financial and investment centers in the world. Thank you very much for participating in today's event. And I'm really grateful to all of you that spent time on us and explained to us what is going on in the United Kingdom. Thank you very much.